Hi, my name is Spencer Leu, and today I'm going to talk with you about what is an equity indexed annuity. If you've ever heard about these, they sound really great in that they say you won't lose any money because of the fixed portion of the account, and you can participate in the upside of the market, for example, an index like the S&P 500. That sounds great, but let's take a closer look at this and see what's going on to determine if this is a viable investment for you. Okay, so how this works is you start with your premium, and that's right here. And from there, that goes into the contract. And after you put it into the contract, the insurance company is going to invest that for you. And after they invest it, of course, they take out their fees for management and whatnot. And then they're going to credit a portion of that to the fixed account. So that's your guarantee. Let's say this is like 3% here. And then the other portion, they're going to invest in options. So this is a misconception. When you invest in an equity indexed annuity, you're not actually invested in, let's say, for example, the S&P 500. They're buying options on the S&P 500. Now, if the options return more than the 3% fixed, then you will get a portion of that depending on the contract. Now, if they don't return anything, then you'll get this fixed amount that was stipulated in the contract. So, not a bad deal in terms of you can't lose money, but let's take a closer look at this in terms of the options, in terms of how that all works, in terms of the fees, and how that breaks down. So let's say we go out, we buy some options on the S&P 500. First thing to note is options do not include dividends. So the reason why this is important is historically the S&P 500 has averaged around 12%. Well, dividends have been a decent portion of that, around 3% or so. So if you subtract that out, on average, without dividends, you're looking at a return of 9%. So we buy options. On average, they return 9%. And what the insurance company has is a couple of different things depending on your contract, which will reduce this 9%. The three things they have are a participation rate, fees, and a cap. So let's take a look at the participation rate. Let's say it's 80%. And let's say your fees are 2%, and let's say you have a cap of 12%. If you earn 9%, you're going to multiply that by the 80%, because that's how much you get of the actual return. So that's 7.2. Now you got to subtract the fees of 2%, and you're going to end up with 5.2%. So even though the S&P 500 may have returned 12%, you'll have credited to your policy 5.2% in this equity indexed annuity. The cap in this case doesn't matter because it's 12%. It's greater than the 5.2%. So that's something to keep in mind, even though the idea is that you're participating in any increases in the index. Your actual return is going to be considerably less because you don't have dividends, and there's this participation rate and fees, which are going to drastically reduce the amount that's actually be credited to your policy. But the reason why most people like these is because there's usually a guaranteed minimum. So, for example, there may be a guaranteed minimum that you'll receive 3% on the account, so you'll never lose money. Again, that sounds great, but remember, this is always based on a percent of the account. So if it's 100%, that's great, but usually it's something less than that. So if that guaranteed minimum is based on 90% of what you invest, remember, it's going to take you a couple years to break even should this policy not produce anything. So one alternative that if you're looking at a vehicle like this If you really don't want to lose any money, but you like the guaranteed interest that you can earn, maybe you just want to consider a fixed annuity. And if you want to have some upside potential in the stock market, invest in something like an S&P 500 index fund, which again will give you the full return of the fund, and you'll still have the fixed annuity in terms of the safety portion if you don't want to lose any money. This might be a better combination for you than investing in an equity indexed annuity, which is going to cap you on the upside if the market does really well, and it will protect you on the downside. But again, the cost for that is pretty high given what you're getting. You might as well just break it into these two vehicles. For this one for safety, and then if you want some potential growth, then you just break it up that way, and it might be a more efficient way to do that than buying one of these equity indexed annuity products. Well, thanks for watching. If you have a moment, please read these important disclosures. I'm Spencer Leu, the Finance Guy.